Keith, good to have you all the way from Dubai. I think a lot of people are wondering, about gold itself. So, how do you look at gold? Do you look at it as like an inflation hedge, a soft haven, a store of value? So, when you look at gold, how do you see it?
It's kind of all the above, but I have to preface my remarks by saying that I'm somewhat of a contrarian guy, and my views don't necessarily fit the standard view on a lot of these things. I break down, people define inflation roughly as rising prices, and a lot of the cause of rising prices is non-monetary. If we have tariffs, for example, that's going to cause prices to go up. If we um, have regulatory issues, or we make energy more expensive with green energy policies. All these things can, make prices skyrocket, but they're not monetary. And therefore, the price of gold isn't necessarily going to respond. And then a lot of people, usually the anti-gold people, will say, see, I told you, gold's not an inflation hedge. Yeah, gold responds to monetary debasement, but not necessarily non-monetary, rising prices. When people say safe haven, usually I think what they're referring to is something you can put your money that isn't going to go down in price when other things go down. And certainly of late, gold has been, behaving that way, but not always. The gold price is a two-directional market. It can go down, and it's easy to forget that in times of extreme bullishness. Now, I don't think the sentiment is extreme bullishness in gold right now, but certainly the price has been relentlessly bullish. We're just about double where we were at the beginning of last year, which for gold is pretty incredible. But what I think is really driving this is an increasing realization and increasing concern that the fiscal picture is, completely hopeless. When you look at how much debt we have and how fast it's increasing, is there any possible way that this could be repaid by the American taxpayer? And and the answer is no, of course not. I think that's, certainly been true for a long time, but people come to that realization in waves. And I think we're kind of having a wave between the big, beautiful bill, between other things going on, that people say, okay, this is something I need to think about, and how do I protect myself? And gold is the anti-dollar. It's the thing you buy when you don't want dollar exposure. And so that's going on all around the world. It isn't just the U.S. In most places, they're buying it as the antidote for their own currencies, which are basket cases even compared to the dollar. You look at India, the Indian rupee is like every year for decades down about 8% a year against the dollar. And let alone what the dollar is doing right now, objectively. The Turkish lira could be hyperinflation imminently, maybe not. It's hard to tell. But they're all buying gold to protect themselves against, the Turkish government and the Turkish currency. In China, everybody is, looking for ways to dump the yuan, and buy dollars, primarily, but buy gold secondarily. And then finally, you have the Arab world, and that's the only of the four major buyers of gold right now. I think that's the only one that's really thinking about the dollar and geopolitics and monetary policy and not liking the dollar. The other three are really not liking their own currencies even more. But in the Arab world, here in UAE, for example, but the other currencies here, they're stable. They're pegged to the dollar. Those pegs have been stable for decades. Nobody has any reason to worry if you wake up tomorrow morning that the value of the UAE dirham is going to be down. And yet they're buying gold, hand over, maybe a slight exaggeration to say hand over a fist, but they're buying gold in a way that you can't really picture it in looking at the gold market in the U.S. right now, because retail in the U.S. is sitting on the sidelines.
Do you think that that's partially because of the economic, tension there between the U.S. and parts of the Arab world?
I think it's part of it, and I think part of it is, the dollar. Well, this was said in 1970 or something. Yeah, it's our dollar, but it's your problem. They get on the short end of the stick of it. They don't have dollar swap lines. They have to be very, how they maintain that peg is by moving their interest rate around to try to maintain the peg. And so that means they can end up with higher interest rates at times that are inconvenient. So I think they love America generally here. And as an American, I feel very welcome. I think it's been fantastic. But they don't love our monetary policy. And they probably have some disputes with our geopolitical policy as well.
So Keith, I've been buying gold for 20 years, right? Like a long time. And I just slowly have chipped away at it, all on the physical, not necessarily on the ETF side at all. But it's funny because I've been following monetary policy. I've been following the printing. I was around in the 2008 when they bailed out the banks, and obviously we just had the stimmy issue, from the pandemic period, which kind of really went to the people, I would say. And so I've been waiting for, gold has just slowly kind of chipped away, and the dollar's been all over the map, well, the US dollar, right? The thing is gold is a worldwide, medium of exchange, and so a lot of people focus on U.S. dollars, but it's really worldwide. So when you named off all those countries and you named off all these things that are going on, it really is when there's international stress, around their currency or even on the U.S. side. That I see that people kind of flood into the physical metal.
Yeah, absolutely. I mean, you look at India, it's a population of 1.4 billion people. Now, per capita GDP is about $3,000, so they are not just a little bit poorer than Americans, but a lot poorer. But all 1.4 billion of them want gold, and they buy whatever they can afford. And in America, it's a much richer country. Obviously, population is about a quarter of that in India, but I would say well under 1% of Americans have any gold or any desire to have any. Turkey, they have gold bank accounts in Turkey, by the way. You can walk into a bank and get a bank account denominated in gold. You get an IBAN, international bank account number. There's a population of 80 million people in Turkey, 120 million gold bank accounts in Turkey. So they are with gold bank accounts the way Americans are with guns. I mean, there's more than one gun per person. Well, they have more than one gold bank account per person, in addition to the physical. But, every Turk would have some physical gold, as well.
I know when I dug into the ETFs, the electronic traded funds, there's more gold stock than there is physical gold. So one of the things that's always concerned me is if there's a run, let's say, that there's not enough physical gold to cover. We've seen this with banking and stuff like that. So when you're looking at, gold bank or gold stock or where do you land with regard to that? Because for me, I if I'm going to do gold, I want it physically in my hand, right? How about yourself?
I mean, that's part of it. But then there's a point at which, okay, what's the risk of robbery, home invasion, theft, fire? You can't insure, gold bullion held at home generally.
Right.
So I think everybody should have a dozen or a dozen, 1 ounce gold coins at home. Sure, absolutely. Beyond that, I think it depends on your home, situation, whether that's safe. There are a lot of things that are unsound. I mean, these gold bank accounts in Turkey, all the commercial banks are obliged to give the gold to the central bank, and the central bank is using it to fight the need for, because everyone's buying gold, so they're importing it, which causes people to sell the lira to buy dollars to buy the gold. So they don't like what that does to the value of the lira and the international forex market. So they get all this gold from the people and they're selling it in order to meet the demand. Well, that's unsound. You're lending it to the bank. They shouldn't be just selling it like that. Similar things. They've had a scheme in India, the same thing. It's all about trying to manipulate the value of the currency upward. A vain attempt because it doesn't really work. So those things are unsound. I look at the GLD, which is the biggest ETF. I don't think that they're committing the simple fraud of not having the bars. It's not usually how things work in America. I mean, the system is messed up in a lot of ways, but not usually kind of the simple, like go to prison kind of fraud like that. But the problem is the counterparty risk. If you read the prospectus, and I have at least years ago, I don't know if it changed. There's custodians and sub-custodians and sub-sub-custodians. It wasn't clear to me, like, what would happen in the case of a bankruptcy of one of those sub-custodians. What would happen? And if there's a financial crisis, can any of the shareholders of GLD get any of the gold? I think the answer is pretty clearly no, you can't. You'll realize the dollar value of that, But then in certain kinds of financial crises, the dollar value of that kind of gold may not match the value of the gold on the street. So we call that backwardation in gold, which is one of the, in fact, that's how I think the system is going to fail in the end. So, it's a great trading vehicle, right? If you want to bet on the price of gold, either short or long, the ETF was a great thing to jump in and out of. The costs of fees are low and it tracks pretty good, at least in the short term. But in terms of holding gold, I wouldn't really put holding GLD up there in the same way that I would put, holding metal or having metal in a Brinks account or some other, thing where you have title. The key is title, really. If you don't have title, then it becomes unclear what happens.
That's a really good way to say it. Yeah, you got to have title. I know when you and I met in person, we talked about the best way to store gold. What are some of the best practices that you've seen? Because I agree, you should not have it at your house.
Yeah, so, if you don't have it at your house, then you're going to have to pay somebody professionally to vault it. And you want to look for, somebody that has a reputation and that's their business professionally. And, there's a variety of ways of doing that depending on the size of the investor. I mean, if you want to put $2,000 into gold, you're going to have to sign on to one of those gold 2.0 programs because Brinks isn't going to take your account or anything like that. If you're a family office and you're putting 10, 20 million into gold, you can open an account at Brinks or anywhere else. And that may be a better option in terms of the safety of it. Obviously, I recommend monetary metals where you get a return on it versus, paying for storage costs. But either way, the key is, do you have clear title? Do you understand it's a custodial relationship that has that gold under bailment or safekeeping and not a credit of some sort? Which, ETF, the exchange traded funds, I think it's actually an ETN, exchange traded note, if I'm not mistaken, which means it's a credit.
Right.
And that's an important distinction. Is it title to metal or is it a credit that somebody owes you metal? The dollar bill used to be a credit where somebody owes you metal, and then all of a sudden they declared, well, we don't owe it to you anymore. Sorry.
Yeah. So I think let's just walk. I don't want to gloss over that, because I think people might know that the dollar used to be tied to gold. With the Bretton Woods agreement, right? Back in the 70s, that was broken by Nixon. And then from there, it became free floating. Then the dollar became more fiat, right?
Yeah, right. I mean, prior to 1971, that was, no, not for Americans. So in 1933, President Roosevelt severed that link for American citizens. It was illegal to hold gold, and you couldn't redeem a dollar bill anymore for gold. Before that, a $20 bill, you'd hand that to a teller and get a 1 ounce gold coin. And then after 1933, that wasn't possible, but for foreign governments and foreign central banks up to 1971. And, after 1933, Roosevelt revalued it at $35 an ounce. So you had to bring in $35 to get 1 ounce of gold. That started to happen in increasing volumes through the 1960s. It was a real crisis by 1971. And, Nixon made his fateful decision. But the point is, that used to be a promise to pay gold. And by degrees, they reneged on the promise. And, it's a real black eye on the U.S. government.
Yeah.
It's a dishonorable default because they had gold.
Right.
They're bankrupt.
Right. And then it's been a printing press ever since. And I know, like, we watch, if you watch it over a long period of time, you can see it was printed for entitlement programs, for wars, for, all kinds of things that we did. But the point is when you put more dollars into circulation, it devalues the dollar. And that's why it was interesting, because I read Larry Lepart's book, talked about, how inflation kind of tracks gold prices in a lot of ways. And it also tracks the decline of the dollar. You have any sense around that?
Yeah. I mean, as I alluded earlier, when the dollar is going down because of debasement, you'll see that in gold. In fact, I think gold is the best way to measure it. So on our website, we measure the price of the dollar. When people say the dollar is going down, they usually mean the dollar index, which is really just the euro. So the euro can move up and down against the dollar. That's like somebody running up and down the stairs on the Titanic. I mean, the whole thing is going down, but the euro may be going up to a higher deck, temporarily. But the way to measure the dollar is gold. So to put this all in perspective, before they created the Fed in 1913, the dollar was 1,500 milligrams of gold. It's now down to about 8 milligrams of gold. So you measure the loss well over 99%, 99.5% roughly. And so, that's going to continue. And that's, people call it a gold bull market and they're excited about it. Actually, it's just the collapse of the currency with which everybody's capital is held.
Right.
This is really a tragic and horrible thing. And if you own gold, at least you're avoiding the losses.
Right. And I think, for the longest time, I used to think of gold as kind of a hedge against the dollar. And then you brought this monetary metals concept where you're actually leasing the gold. You want to chat a little bit about how that works?
Yeah. So, very simply, there's about a dozen different verticals that are using gold, physical gold, as either inventory or work in progress. So think of a refiner, a mint, a recycler. So when you're done with your phone, you drop it off at Walmart or AT&T or whatever. That there's a lot of different people that want different pieces of that phone. The glass has value. The lithium-ion battery obviously has value. I think the chips have value. And then the bare naked circuit board has some gold on it and silver and some other things. So those things go into very large, piles, and there's companies that buy those by the container load based on the expected gold value. Grind them up, extract the metal dust out of it, and send that off to a smelter. And there's jewelry manufacturers, there's fabricators, there's all kinds of different companies that have physical gold inventory. And if this were copper, you just buy it and be done. I mean, copper is $4.50 a pound, but gold at $3,800 an ounce has to be financed somehow. And normally, what they do is they borrow dollars, and then of course you have this mismatch. You have the dollar, which is your liability, and you have gold, which is the asset. And so, if the gold price drops, 10%, let's say, you have $900,000 asset against $1 million liability. You're insolvent. So then they have to hedge. So hedging adds complexity and moving parts and costs and risks. Or you lease the metal, and then as long as you have the agreed upon amount, let's say we lease you 1,000 ounces, as long as you have the 1,000 ounces in the business, which we are verifying every day, we're very aggressive on monitoring, the metal, then it doesn't really matter what happens to the price. You have no exposure to the price as a business. You have the metal you need to operate the business, and you're paying interest for the privilege of getting that metal you need. And we pay, we obviously make a fee, but we pay that interest to the people who own the gold. So it's gold with the return versus gold with, storage costs. And we think that's the game changer.
Yeah. Well, congratulations on your success. Like for those people that are new to gold, like for the first time listening to this, it's really an interesting market. You can't find it in a lot of places. I have a couple guys that call me every once in a while when they get it. What's the best and safest, most effective way to get it?
Well, if you want to buy some gold to have in your possession, there's two schools of thought on this. One is you can go to the local coin store, on Main Street, usually somewhere downtown, and, buy a handful of coins. And you could do that with cash, which means nobody knows you have it. Hide it on your person, bring it home and hide it basically, and that's it. The problem is if you're doing any significant amount of value of it, you're really, really uncomfortable. And I've done this, walking out of that store and you just assume everyone knows you're carrying gold. And you get to your car and you're like, I better not have a fender bender or nothing better happen. It's an uncomfortable, place to be. But maybe for a little bit of gold, everybody having 5 or 6 coins in the sock drawer, as it were great. But for larger amounts, for most investors, that's going to mean some sort of program where, you have an electronic access a website, app, whatever. And then you want to be mindful of the spread you're paying. So if the gold price is here, when you buy, you pay something above that. And when you sell back at the end, you get something below that. Now, those spreads should be fairly tight on a program. Ours are well under 1%, for example, at Monetary Metals. And, obviously, if the price of gold moves up 50%, most people don't sweat paying, even, 1% or 2% or whatever. But, mind those spreads, that matters. And then, mind the reputation of the party you're working with. But, I guess here's the thing. Gold is literally a commodity. And everybody tries to brand it why their gold is special. But the whole point of gold is it isn't. It's element number 79. It's AU and, the periodic table. And all gold is the same, which is the whole point. It's fungible. So make sure you're getting the real stuff. Make sure you're dealing with somebody you trust, especially if you're storing it. Make sure you're not overpaying for it. If it's branded special gold, whatever, be wary of that. You can lose a lot of money on that stuff.
Is there a world where gold goes down and the dollar goes up? Like where the dollar inflates, but gold loses its value?
Yeah, absolutely. That's possible. Look what happened in 2008. Gold hit over $1,000 an ounce was it April of 2008? And by October or November, I don't remember the exact date, the price of gold was just a hair under $700. So 30% down in dollar terms. Now, what was happening was the dollar was going up in value massively because there was a credit crunch. People were desperate to get their hands on dollars to service their debts. That's the thing about our, financial system. People look at the supply of dollars. They don't look at the demand. And every debtor has a relentless demand for dollars because if you don't service your debt, they take your house, they take your business, they take your farm, they take your car, they take everything. And so at times when the Fed creates, scarcity conditions in the dollar relative to all this demand, then, you get this incredible crunch and, a financial crisis. And in a financial crisis, price of gold can drop substantially. Now, in this particular case, and I've written about this, I think in the next financial crisis, if there is one, the price of gold will drop less than it did as a percentage than it did last time. So last time was 30%, but for a variety of reasons, I think it will drop less this time around.
Well, what are those reasons?
One is I think there's less leverage in the gold market than there was at that time. I think another is that there are a lot more people that are aware of what's going on and that these crises are, the dollar itself essentially going off the rails. And so, in 2008, you might have had a lot of people just sick and tired of that gold, losing on it, just dumping it out of disgust. I don't think there's going to be too many people dumping gold out of disgust. Maybe forced selling. I forget which trader, a very famous trader, who said, when markets crash, it's not because people are choosing to crash it. It's because the margin clerk has taken over the accounts.
Yeah.
And he's just indiscriminate selling and unchosen, involuntary. But I think there'll be less of it this time around. So as a percentage, 10, 20% maybe. Obviously, it's a wild guess. And there may not be a crisis of that sort because I think, if you listen to what the Fed has been saying, and they've been saying this for a very long time, the Fed today thinks that the Fed of 2007 to 2008 was asleep at the switch, grossly negligent. They think they totally weren't doing all the things that the Fed should be doing. Now, whether or not you agree with that is a whole different matter. This is their view. And so therefore, they resolve right now to be, I call it hyper proactive. The slightest little sign of the slightest little disturbance, and they're there, tamping it down. So, if the analogy of the system is maybe like this is a dike in Holland and the water is leaking through, they have 1,000 tentacles to plug 1,000 leaks, and they're just super, super proactive on it. And so there may not be, that kind of crisis. The next crisis is going to be maybe very different, maybe much more of a inflationary type versus the deflationary type that we had. I know it's very hard to say because you're predicting, two things, which is one, where's the system headed, which is bad enough to try to predict. And number two, what politicians are going to do. And that's impossible to predict. I don't think they know what they're going to do. Let alone do I know what they're going to do.
Yeah. Yeah, Ken and I talk about that. The Fed, when they fix something, it's just essentially inflationary because they're going to, print money or loosen, lower rates, which loosens credit and all of that.
They try, but then, the forces they're playing with are much bigger than they are. And
Mhm.
so, you end up with the forces of what people will call deflation from arguably summer of '08, maybe earlier, but certainly at least then, through 2000, end of 2009 for sure, maybe into 2010. And so they don't have as much control as one would think, and there are lags when they do something. There are lags before what they do, has any effect. There's a lot of debate out there about when they lower interest rates, does that cause asset prices to fall? And certainly there are people that can show data that it correlates with falling asset prices. Now, I look at it and say, well, duh. That's because, at least historically, they've waited until asset prices are collapsing and then they lower rates or right into whatever crisis is causing that. And of course, the lower rates don't affect the market until everyone who's over margined and defaulted and 90 days past due, they all have to be wiped out first. And that takes a process of months, if not a year or two, during which time interest rates have been forced way lower. And so you could say, well, lowering interest rates causes lower asset prices. No, but if they do that in response to a crisis, temporarily, you'll see that correlation. Does that make sense?
Yep.
Yeah. It's I'd like to talk a little bit about, the Eurodollar, right? Which are, the world, as trades in dollars primarily, not everywhere, but I don't know if people recognize that. But when we buy goods from somewhere else, we pay them in U.S. dollars. But that's really not the point I was trying to make. What I was trying to make is they're using those dollars to buy gold in a lot of places, and I saw like a lot of these countries are actually getting out of U.S. dollars and buying gold. Can you touch on that a little bit because it's quite remarkable. When you look at Russia, you look at China, you look at a lot of these countries actually loading up.
So there's definitely some central bank buying of gold. But of course, when they buy gold, that means someone's selling it. And when they give up their dollars, that means someone else is taking those dollars. And the Eurodollars are not, coming back to the U.S. There's other parties in the world that are desperate for it. Now, again, as I said earlier, me being contrarian, I don't think China is dumping dollars as the decision to do so. Yeah, they buy some gold for sure, but I think they are obliged to do so to maintain the currency peg, because I think there's such enormous pressure to dump the yuan amongst 1 billion people in China. Everybody who can is dumping. Whether they're risking their life to do so, because number one, it's illegal in China, their capital controls, and number two, when you break laws like that piss off the government, you can die. I mean, it's not like, the IRS comes along and charges you penalties and interest, in China, especially for a crime like that. So under that kind of pressure, they're selling dollars to buy their own currency back in order to maintain, sort of a managed retreat of the currency in a way. But there's definitely buying of gold as well. So there's two things going on, which is actually a dollarization. All the other paper currencies are failing first. Yes, the dollar will fail last. And in the meantime, all the other ones are failing. And you'll see the Argentinas of the world, and probably sooner or later, rather than later, the Turkeys of the world end up dollarized. The demand for the stuff is relentless. What the Eurodollar really is when somebody in Turkey lends to somebody in Kenya. They could do it in lira, if there was any demand for lira, which there isn't. They could do it in the Kenyan, I think it's shilling, if any creditor wanted to hold a shilling, which they don't, or they do it in dollars. So, you have the Turkish banking system creating dollars completely outside the U.S. and completely outside the Fed's control. That's the Eurodollar system, essentially. And it's massive, probably a lot bigger than the domestic dollar system, and not that well understood, and the statistics are harder to get. And the dollar is in universal demand in these places all over the world, and for a lot of reasons. So, for instance, if somebody in Turkey wants to buy coffee from somebody in Kenya, just crossing those two currencies, the lira to the shilling, is about a 10% frictional loss due to bid offer spreads. And if they're willing to do business in dollars, it's so much easier and so much less frictional. And so there's just a lot of reasons like that why the dollar, there's no paper currency that can replace the dollar, but gold will in the end. And more and more people see that, and they're buying gold. So those are two trends happening at the same time, in my opinion.
Well, yeah, it just falls back to what it originally was, right?
Money.
Yeah, I mean, gold was here long before paper.
That's right. And the paper was just a claim, to be paid gold at some point.
Right.
And the rest of most of the world has lost that.
Yes, I wanted to. I just wanted to ask you: are you familiar with the run on silver? Do you track that much? Because that's also been interesting.
So I follow I follow obviously the gold and the silver markets. What I can say, I mean, I tend to, tamp down a lot of, just say, the rumors, the conspiracy theories and stuff. Silver allegedly has been in a structural supply deficit for longer than I've been following it. And that hasn't necessarily correlated to the price because it's been up and down, quite a lot. But what I can say is that, during the endless bear market, so for silver, the silver price peaked in, I believe it was March, maybe early April of 2011. We hit just about $50, not quite. And then, ever since then, certainly through 2018 into 2019, it's a bear market. And every time it blipped, I follow a particular piece of data, which I'll describe in a minute. All the gold and silver people were saying, that's it, it's a moonshot, on every blip. And I'd put out an article saying, not going to happen, here's a picture of supply and demand. So I follow something called the basis. This is all available on our website. We have daily updated graphs for free, which is basically the spread between the futures market and the spot, and it's futures minus spot. And that is telling you a lot, but very simply, if you see the price going up and you see the spread between futures and spot is widening, that's telling you the buying is in the futures market. And the arbitrageurs will pull up their spot price, to make the spread, but it's with a lag and with not as much enthusiasm. So the spot price comes up, but a little bit less. So you see the basis spread widen. And every time that happens, I can say, look, this price increase isn't durable. They're buying it in the futures market only. And the futures market's a short-term trade. I mean, using 20-to-1 leverage up to, and there are costs in that market. If you really wanted to hold metal, you wouldn't be doing the futures market. So if the only buying is in the futures market, it's, probably going to reverse and come right back down. And that's every one of those blips for, 7-8 years. That's what it looked like. Right now, what's remarkable is a very different pattern. We see the price of silver rising, and we see the basis falling. And that's been that way for, at least $10 of this, price rise, something like that. And that means that this is buying of metal, and the futures market isn't really yet responding to that, to my comment earlier about less leverage. So this is more durable. Are we going to break $50? That's the first thing everybody wants to ask. I don't know, but I think we got a really good shot at it. And the more that, this basis pattern holds with now the prices, $47, $48, yeah, it seems more likely. Now, could there be correction in the short term? Yeah, there could. But this is a buy the dips market. This is not a sell the blips market that we had for all those years. And the supply and demand picture in silver is stronger than that in gold, notably right now.
So let's talk about kind of the economy and where you see it heading over the next few months, right? Because, the Fed just switched positions on keeping interest rates high, and now they're starting to lower that. So do you think that this is like a traditional cycle where the Fed drops the rates, asset prices increase, we stay out of a recession, or what is kind of your outlook?
So I think there's been a lot of pressures for lower rates this whole time that, that they were hiking and then said they would hold it higher for longer. And I've been, writing and saying, you can't, you're fighting the tide with this. Now, of course, President Trump wants lower interest rates. And I think he's going to get what he wants. But I also think he's going with the tide in this case, is not fighting the tide. The trend is going to be down anyway. And now he wants to force that faster. And he's going to replace, Fed governors and other things. He's going to do whatever he needs to do. So, in any case, Powell retires, or his term is up in 2026. So, yeah, I think interest rates are coming down. Do we avoid the recession? That's a very interesting one. There's a lot of indicators right now that seem pretty ugly. So there may already be one baked in the cake. I'm not necessarily the best guy to, try to jump all that and cite this data versus that data versus whatever. Anecdotally, I think things are getting softer. But I think that the economic damage of the tariffs is something people aren't really grappling with. It takes a lot of time for that to work its way through. Because first of all, the tariffs are very well telegraphed. So everybody who could bought inventory, right? And so now there's a lot of cases still working off inventory that was bought pre-tariff. And then secondly, even domestic manufacturers rely on imports to make their various things. Farmers near the Canadian border are buying fertilizers, from a Canadian supplier. And the nearest U.S. supplier could be hundreds of miles away, and it doesn't pay the truck. Fertilizer is pretty low value. So there's a lot of things like that I think are going to hit jobs and hit prices in counterintuitive ways. Like if the fertilizer from Canada is more expensive and the farmer near the border can't really afford to truck in domestic produced fertilizer, he may just go out of business. And then we have a slightly reduced supply of whatever it was he was farming. But I think that stuff takes time to work its way through, the job losses and, the rising prices. So there's a term which I don't like, stagflation. And I don't like the term because the Keynesians thought that you have a trade-off between unemployment and inflation. And then we get to the 1970s, and I'm just old enough, I was a kid in the late 70s, to remember we had really high both. Unemployment was, 12 or 15%. Inflation was 13%. And so they coined the term stagflation because it seemed to be violating all the Keynesian rules. The whole theory should have been thrown into the dustbin of history, but instead they coined this term. But I'm reasonably confident to say we could be in a period where, at least for a while, we're going to see continued rising prices as the effect of fiscal policies and, falling employment as the effect of, kind of the credit cycle, which is going to be a very not fun, place to be. And I hope that we reverse ourselves on tariffs. I hope we negotiate with all these other countries and, go back to free trade again. But I don't know that my wish is going to be granted.
It is sneaky. Like we had somebody on our YouTube live today say, they supply freezers. They manufacture freezers. The freezer prices are going to go up 15%. So like there's all these weird things that you don't think of that are kind of, like you said, baked in the cake where, prices have to go up because the expense of doing business is going to go up.
And, minimum wage has gone up in a lot of places. And, people think, okay, well, then the restaurant's going to charge more. It doesn't work that way. What has to happen is you'd have to destroy marginal restaurants, right? So then the survivor, the remaining survivors can raise their prices.
Mm-hmm.
But, prices are set in this market and the wage is set in this market, and they're not, directly connected like that. Yeah, so there's more unemployment coming, almost certainly, whatever else may happen. But I think this unemployment is going to be tied to reduced supplies of a lot of things, which means higher prices.
So Keith, I know, when inflation jumped to 9.1, I guess it was in June of 22. I think people kind of woke up during that period of time, regardless of what it was for. Maybe it was the stimmy checks. Who knows? What gave it that temporary spike. But we started to see kind of a flight from dollars, I guess. Like my dollars buying less. And so we obviously part of that's gone into metals. Another piece of that went into Bitcoin, as you know, and we've had this kind of a wild run. So where do you, I know you follow this, but where do you stand on Bitcoin? Obviously the blockchain, and, how does it compete as another form of value? I know the Bitcoiners say it's a store of value and all these other things, and there's a lot of marketing around Bitcoin, just like there is around gold and just like there is around the dollar. But where do you think this is all headed?
I think there's a lot of interesting technologies there, blockchain, um, and not just the Bitcoin blockchain, but other blockchains. There's some really interesting innovations, for sure. But Bitcoin, as such, is just an irredeemable currency. Now, unlike the dollar as an irredeemable currency, the dollar is backed by debt, which is really important because it's the struggles of the debtors that give it value. There is a ferocious, relentless bid on the dollar by everybody who's in debt. If you're a farmer and you owe $1 million, you must go out and grow as much crops or as much livestock as you possibly can, bring it to market and dump it on the dollar bid price desperately to raise enough dollars to service your debt. Well, Bitcoin doesn't have that. It isn't backed by any debt. It is just a fiat. It's just, there it is. Somebody printed it, but they have rules around who can print it and how much and how fast and all that. But that's what it is. And so the price and value of Bitcoin is just set completely by the marginal speculator. And when the marginal speculator has got the bit in his teeth and wants to run, you could see this thing running up, massively. And when the marginal speculator gets bored, or there's another asset class, or there's a scare, or there's a need for liquidity or whatever, then Bitcoin have these vicious sell-offs. And so, my comment about Bitcoin being store of value is I would say even during phase one, skyrocketing, it's not a store, of value. It's something else. The skyrocketing, which is great, if you can pick the timing of that, you can make a lot of real money, i.e. dollars. But Bitcoin isn't suitable for lending. Nobody in their right mind would borrow Bitcoin. And in fact, even the cryptocurrency companies don't. So we put out an article, this is years ago now, Coinbase announced they did $1 billion bond issuance. And we put out an article that said gold 1, Bitcoin 0, because we had sold a gold bond. And, the biggest one of the biggest crypto companies or biggest crypto exchanges sold a dollar bond. So what do they really believe in when they need to raise capital for their own purposes? Dollars. And I think that just says it all right there. Leaving aside all the hype about Bitcoin as money and this and that and the other thing, nobody would borrow it. Why? Because it's supposed to go up like 1 million billion times. Why would you borrow something that's going to go up? I mean, imagine, you buy a house and you have a mortgage payment of $5,000 a month, but everyone's telling you that your mortgage payment is going to be $50 billion a month in 10 years. You'd be ruined, obviously. And then it's not suitable for saving. So I had a debate. There's something called the Soho Forum, which is sponsored by the Reason Foundation, invited me to debate Pierre Rochard, who's a prominent Bitcoin guy. And the debate took place at the Mises Institute in Auburn, Alabama. So there was a live crowd of a couple hundred people, and then it was on the internet. I don't know how many people participated live. And we're talking about this, savings. And I said to my opponent, are you saying, when you say savings, let's be clear, are you saying like suitable for an octogenarian widow who has no further income potential remaining in her life? He said, absolutely. And then, so that debate happened to take place right after a 79% drawdown in the Bitcoin price, because they went from $69,000 to $13,000 or whatever. This was shortly after that. And I said, well, what would you say to the octogenarian? She's 87 years old, widow, no more income potential. She has all of her savings in Bitcoin, and it drops 79%. What would you say for her to do? I didn't quite hold the microphone up to him, but he said, buy more.
Yeah.
Now, I kind of cheated a little bit because the rules were this is like his final rebuttal. I wasn't supposed to say anything. So I kind of mimed to the audience. I'm like, and Gene Epstein, the moderator, who's kind of like, now you can't be saying anything. It's not your turn anymore. Sorry, but I think there were a couple of moments where I think I won by a landslide. I think there's a couple of moments where I could tell he really lost. And that was one of them. Tell her to buy more after it drops 79%. And by the way, supposedly all of her savings is already in. She's already
money.
One of the things that you articulated was, what if she didn't have income? If she doesn't have income, she's not buying more.
Right. So, for people that are millennials and, and retirement is 30 years in the future, yeah, sure. Okay, I get it. But There's a lot of problems with it.
So I know we're running out of time here, but crystal ball, you got Trump in office for the next 3 years. How much does a administration, president affect, obviously in this particular case, this president, monetary policy, gold prices, Bitcoin, etc.?
I think in general, the Fed has a lot less, control, and certainly over things like the gold price than is sort of presumed or assumed. Um, and I would say the president has even less power, but I think Trump is trying to take much more direct control over Fed policy than any other president I've ever seen. But that said, I think we're in a durable bull market for gold, which means a durable bear market in the dollar. So if the dollar is 8 milligrams of gold today, yeah, we're going to see 7, we're going to see 6, and so on. How fast that happens, I think God help us all if that really starts to accelerate, because I think that's what the end of civilization looks like. And I'm not saying that just to be dramatic or scary. Be careful what you wish for. I've been saying that to the gold people for a long, long time. If gold hits $5,000 or $10,000, and we're not that far from 5 anymore, it's not so crazy, but let's say $10,000 now. Yeah, you have a lot more dollars if you want to sell your gold, but number one, you probably don't want to sell your gold in that scenario. Number two, let's say you did and you bought a Ferrari. That's not a world you necessarily want to be seen driving a Ferrari. Hopefully that doesn't happen, and hopefully we stabilize and hit whatever the new normal is, and people can get jobs or welfare or whatever. And I'm not indifferent to that. Hopefully it's jobs and not welfare, but hopefully we stabilize and this doesn't just keep running up. But on the other hand, I think it is going to keep running up, and the only thing I can say is hopefully not too fast.
Well, you mentioned earlier in the interview the system will fail in the end, and I wrote that down. So I'd love for you to talk about what you see.
So at the end of the day, it's the people who own the gold. I'm sure you've heard sort of the alternative, tongue-in-cheek, golden rule. The people with the gold make the rules. Not the classic golden rule, but at the end of the day, it's the people with the gold that decide the fate of any currency. And it's when gold stops bidding on the dollar. And that's what I call permanent gold backwardation. My most important article, maybe you can put a link in the at the bottom, When Gold Backwardation Becomes Permanent, describes the death of the system. It's when gold withdraws its bid on the dollar. Now, what do I mean by that? In any time of crisis, it's always the bid that's withdrawn, not the offer. So suppose the U.S. Geological Survey says there's going to be an earthquake in L.A., 15 on the Richter scale. Nothing taller than a dollhouse will be left standing. No, they're not saying this. I want to be really clear, but this is a hypothetical. Then what I would expect to happen is there'll be no lack of offers to sell real estate in L.A., but there will be no bid, probably from Santiago, Chile, all the way up to British Columbia, and maybe as far east as the Mississippi River. There'll be no bid, as everybody just pauses, holds their breath, and waits for the earthquake to happen. When it finally does, a new bid will come in, and perhaps lower, and perhaps not. So the bid withdraws. Now, gold, a lot of smart people have observed, when things get crazy, gold withdraws its offer. Gold is the one, unique, different thing that behaves opposite of any other asset ever. No, everything is the same. It's the bid being withdrawn, but you have to understand that we're living in this dollar bubble where we think gold is offered. Gold is the money. The dollar is the credit. Gold is bidding on the dollar. So when the gold holders say, "No, I'm good. I'm holding my gold. I'm not interested in the dollar anymore," then that's the collapse of the. People will call it hyperinflation. The price of every real thing will go to infinity, because the people with the dollar still want gold. It's the gold people who don't want dollars anymore. And so the people with the dollar say, "Well, I could buy crude oil and trade the crude oil for gold." And that trade will drive the price of crude oil to infinity. And the same thing with, every other commodity, soy, copper, iron ore, etc., will all go to infinity until finally we just say, stick a fork in it, it's done. And it won't be because of the quantity of the dollar being printed to infinity. It'll be because gold withdraws its bid. And so, the process of the price rising, especially if it's rising really fast, starts to look like, gold withdrawing its bid, which is exciting if you have a lot of gold on a trade and you want to sell it, but scary if you're thinking about what happens to society, in a scenario like that.
Well, it's interesting too, because as you were saying, a lot of countries want to be in dollars, or, they're based in dollars, right? And so it would be more of a worldwide issue, unlike when we've seen hyperinflation in like Zimbabwe, where it's just a one country issue.
That's right. When the dollar goes, and which I think all the other currencies will be gone anyways at that point. It will be the whole world on the dollar. None of the other currencies will probably be around at that point. Right. It'll take down the whole world. It's not one, random third world country like Zimbabwe when this happens.
Well, Keith, first of all, I just wanted
to end on that positive note.
We appreciate the relationship we have with you guys, Monetary Metals. What you built is an incredible company. So congrats on your success.
Thank you.
Yeah, and we'll put those links in that you mentioned for the audience. You guys can click on that link below on some of these articles. We'll tie you back to the Monetary Metals website. Keith, be safe out in Dubai, and appreciate your wisdom on this topic.
Thanks for having me.
You bet. We'll talk to you soon.
Thanks, Keith.